pain trade is higher for now, and this is what you need to know before the bell. As January continues, markets continue to rally. And here's the important point to look at. After a negative year of returns, as we had in 2022, when Santa Claus visits, and of course we had a Santa Claus rally, just barely, but he did show up on the second day of January, and that's part of that Santa Claus rally. And you have the first 5 days of January being positive. That has resulted in positive year returns 100% of the time, every time that has occurred throughout history. And what that suggests is the probabilities are right now anyway, is that market prices will be higher this year than not. Now, I know that's hard to believe when you read headlines and we're talking about economic recession and rising unemployment and the Fed hiking rates. How on earth could you have positive asset prices? Well, as we've talked about before, there's always possibilities and probabilities. And there are certain things that we can look at that suggest that right now, anyway, at least in the short term, over the next 1 to 3 months, the pain trade could be higher for the markets. And as we've talked about before, the MACD buy signal, which has been selling off, has turned back positive. Our weekly indicators have also turned positive as well, also suggesting higher prices in the short term. And now with the market rising above the 200-day moving average, again, we're going to wrestle with this a little bit over the next couple of days. Don't be surprised about that. But if the market can hold above the 50 and then rise above the 200-day moving average, that's going to complete this kind of rising trend of the markets that we've been developing ever since the October lows, where we've had more stocks now participating in that rally, the number of stocks participating going up, the number of stocks on bullish buy signals also improving. And all of that suggests that we could see higher prices, at least in the short term, with a target of somewhere right around 4,200 potentially for this rally. So again, while there's a lot of bearish sentiment, that is also a contrarian indicator of higher asset prices, because again, as all those people now bearish, and again, lots of commentary out in the media and headlines, etc., about bear markets, recessions, all these type of things. The market has been pricing this in now for over a year. So again, with everybody very bearish on kind of one side of the boat, that leads to the ability for the markets to rally more than expected. Now, does this mean that the markets are just going to go higher from here? No, that's not what it means. What it does suggest is we could see higher asset prices here in the short term. But again, lots of volatility this year. Rallies followed by declines, potentially making higher lows for the markets, potentially even a retest of the October lows, certainly possible. But again, markets are kind of working through this process, adopting all the bad negative information in, pricing that in. As the Fed continues to hike rates, that's going to get priced into the markets as well. The one thing that we have to keep a watch on, and the big issue for the markets over the longer period of the year, is going to be earnings and profit margins. How far do those correct from here? Do they get substantially worse? And do prices have to adjust meaningfully lower to accommodate for those lower earnings? That's the unknown that we'll still have to be dealing with. But again, in the short term, over the next 1 to 2 to 3 months, again, seasonally strong period of the year as well, we could see higher asset prices. Again, watching that very carefully here, but that's what you need to know before the bell.